Hello there. Well, when we've been watching the markets recently, I've been put in mind a little bit of the old Wile E. Coyote cartoons where sometimes he accidentally runs off the edge of a cliff, but then he doesn't seem to notice for a while and he can carry on running. And it's only when he notices that he then plummets. And sometimes at the moment, the stock market feels a little bit like that. There's lots of things going on under the surface that perhaps have taken away some of the ground that's kept the market's going up, but yet the market doesn't seem to have noticed. So we've seen lots of headlines recently, particularly around Donald Trump and some of the things he's doing, things that might have a geopolitical impact, such as in Ukraine or the Middle East, things like all the spending cuts that might happen within the United States government. But particularly we've seen lots of headlines around tariffs. And tariffs essentially are a tax on imports. So most economists think if you put lots of tariffs on lots of imports, then that will push up prices, which is inflationary, and potentially slow economic growth. So that's one of the things that you'd have thought might have had an impact on stock markets. When we look under the surface, we see other things as well. So if you see some of the headlines, some of the earnings announcements, for example, from some of the big tech firms, have been a little bit disappointing. They've not been quite as good as a lot of people thought they would be. They've been fine, but people were very optimistic that they would be even better. So there's been lots of things going on, but yeah, as I said, the market seems to have still carried on going up. And that just makes us feel a little bit wary. Now, not that we are being pessimistic, we still think there's some good returns to be had, so we'll come on to that in a moment. But some of those things I said, tariffs, they have the potential to be what we call stagflationary. We have stagnant economic growth and higher inflation. If we look at the UK economy, we see some other things that could have a similar sort of impact in a different way. So if we look at the national insurance rises and some of the other increases increases to minimum wage, for example, that could increase the costs for businesses, and most businesses, when we look at surveys, are saying that they'll look to pass those costs onto the consumer. So that could keep inflation a little bit higher here in the UK as well, and it could also depress economic growth. So stagflation is something we really don't like as investors. So normally, if you get low economic growth, the central bank, the Bank of England or the Federal Reserve, will cut interest rates. But of course, those banks are also meant to keep inflation down to roughly 2%. And if inflation is higher than that, then it sort of means that they can't really cut interest rates, or not as much as they would like to. So one of the risks at the moment is that interest rates either stay where they are or could even potentially go back up, although that's not what we think is likely to happen, but it could be that they will be cut less than people currently expect. And that generally wouldn't be a very good environment for bonds, for example, because generally you would like to see rates cut, and that would help bonds. But if rates aren't cut or they go up, that's not so good for government bonds. It's not generally good for equities if you've got slow economic growth, because that means slow earnings growth, and that could mean share prices are unlikely to go up so much. It wouldn't necessarily be good for corporate bonds as well, where you're lending money to companies, because not only will the interest rates potentially be higher, but also if the economy is slowing, that means more of those companies might get into trouble and have more difficulty repaying the loans, essentially. So stagflation isn't very good for portfolios in lots of ways. That was the reason in 2022 why it was such a poor period for investors. So most asset classes fell because inflation essentially went through the roof, and the economy really struggled, and interest rates went up by about 5% over not much more than a year. However, and this is the important thing, we don't think we're talking about a repeat of 2022. It's possible we could have slightly higher inflation than we'd like to see, maybe, 3%, 4% perhaps. We don't think we're going to get 11% like we saw then. We might say interest rates might not be cut, might even go up a very small amount. They're not going to go up by 5%. And the other reason we don't think this is anything like 2022 is we are starting from a very, very different place. If we look at bond yields, at the end of 2021, if you wanted to lend your money to the UK government and buy a gilt for 10 years, you would have got less than 1% a year. Now that's about 4.5% a year. if you were going to lend your money to a company back in 2021, the end of 2021, you'd have got about 2% a year. Now it's more like 5.5% a year. And actually there are other types of bonds in the portfolio, what we call short-dated bonds, that actually in some of the funds that we hold have even higher yields than that, more like 6.5%. And because they're so short-dated, essentially, even if interest rates aren't cut or even if they go back up, actually we don't think that will make very little difference to those bonds. So there are assets in the portfolio that we think could produce a really nice, fairly high level of return, but without that much risk associated with them. Another one is defined returns, where yes, we might see the stock market fall at some point in the next few years, perhaps in the next few months. But even if it does, we think with the defined returns product, will it kick out at some point in the next 2 years, 3 years, even up to 5 years? And I think almost certainly the markets at some point will go higher than they are now. And if so, therefore the defined returns products would kick out and we get about an 11% return from some of those. So all of these are kind of illustrative returns, they're not guaranteed, but we think there are some really good things in the portfolio that won't have to rely on the stock market carrying on growing the way it has done, could still give us a good return regardless. So whilst we are a little bit wary and concerned about some of the risks that are out there, we think we've positioned the portfolio in such a way that they won't be so badly affected, and we still think there's some really good returns to be had. So I hope you found that useful, and we'll see you again next time. Thanks.